Hello, everyone. Thank you for joining us for the New Capital webinar, Special Markets Update 2020, number 7. This is Catherine Barr, Director of Communications at New Capital. As usual, we're going to have a Q&A session at the end of the presentation, so you can submit any questions during the webinar, and of course at the end of the webinar for Leonard to answer. The Q&A tool is in the menu at the bottom of your screen. And before we get started, I'm going to offer the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Okay, thank you, and I'm going to turn it over to Leonard.
Hello, everybody. I hope you are doing well. I'm coming to you this evening from my the barn at my ranch because the reception here is decent. Been having some reception trouble inside the house. So I hope you're doing well. It's the dewberry season here right now. And a dewberry, most of you probably know dewberries, they're a cousin to blackberries. And a nice time here picking dewberries. And I did something I've never done before. I made a pie. You can see pie before. I know we have one client on the call today who's an excellent baker. There are probably more than one, but I know one in particular on the call, and so you'd be proud of me. I made this dewberry pie. I followed the Mario Batali. It's actually not his recipe, it's his mom's. His mom has a blackberry pie recipe, and you see I'm going back to Houston this evening to be with the family, and you see I couldn't wait. I couldn't wait to try the pie. So anyway, dewberry season here at the ranch, and I hope everybody is healthy. As I have done before on our past, and this is our 7th one of these calls, and we continue to do them because we get good feedback and people enjoy it. They also like the 6 o'clock time slot on Friday night. I'd like you to go ahead and click your hand raise if you or anyone close to you, close friend or close family member, has the virus. So let's take a second and do that. I'm just, it's our own informal poll. And so I'm looking, so we've got about 18 people on the call tonight. Let me give a few more, a few more seconds here. If you or anybody close to you, you know, has or has had the virus, then do a hand raise. Okay. 4 out of 18, which is about, I think, double from what we have been, no more, 5 hand raises out of 18. 1, 2, 3, 4, 5 hand raises out of 18, which is about double. We've had about 2 in the past. So if that gives any indication, and that's maybe since the 2 weeks ago, that's been a doubling of the New Capital client base sitting in on these calls. So, okay, thank you, thank you. You can put your hands down now. Let's get started looking at a few charts. The big news this week, obviously, was oil. Oil went negative in its price because you have to store oil. It's costly to store oil. And so because there's so much oil, it's now a liability to own it. And I think we've now crossed back into the positive. This is the United States Oil Fund. I've never bought this thing and would never buy this thing, but it's popular with a lot of retail investors. And this is a 5-year chart, and you can see that what used to sell for $20 closed today at $2.57. So you've lost 90% plus of your investment if you had invested in this particular oil security. But I think it has roughly over this time period is mirroring the move in the spot price of oil, and so enormous amounts of wealth has been destroyed in the oil business. The impacts on our home city of Houston are hard to know. We don't know how this is going to translate to all of us in our homes in Houston and real estate in Houston, and been getting some questions from clients about that over the last few days, and we don't know what that impact is going to be. Houston has taken steps to diversify, but whether that diversification is going to stand up or not, it's hard to know. This is a table from the Treasury, the U.S. Treasury. This is showing bond rates, and you can see up at the top in gray are the maturities of Treasury bonds. So 1 month is right here. Whoop, sorry. 1 month is right here, and 30 years is right here. That's a 30-year bond. And where things close today, at the bottom, you can see that a 1 month bond is trading for 0.1. Here, I'll get my drawing tool to make it clearer. And you can see right here, 0.1 is what you're being paid in interest. That's an annualized figure for a 1 month Treasury bill. A 1 year Treasury bond is 0.18%. That's the annual interest. The 10-year, which is the benchmark bond considered to be the risk-free bond, is 0.6. And so look where we've gone. We've gone from 0.62 back on April the 1st, and rates rose a bit, right? 0.77 here on April the 8th, and here we've fallen back to 0.6, which would indicate nervousness. It could also consider, it could also be nervousness that's not necessarily occurring among U.S. buyers, but it could be global buyers. But whatever the case, we have seen a return. Look at this, 0.58, the lowest number for the 10-year over the month to date, came just 3 days ago. So interesting figures. And here's the 30-year. Look what you get paid to loan to the government for 30 years, 1.17%. All right, so it's not too appetizing in bond world, and yet if you're worried in not experiencing the volatile markets, may not have a choice other than to sacrifice return. About that later in the call. Speaking of volatility, here is the VIX chart that I have been showing. This is 1 year of the VIX, which measures volatility. And you can see this is way things usually under 20 or so, and then whamma, the acceleration of the virus beginning into March, and this is where we are now. You see that we've come down quite a bit, not in the normal times, but you see in volatility. Now I'll show you what this looks like over the 5-year period. So this is over 5 years. And I just to remind, 5 years of from this peak. It's approximately equal to where we were, up around 80. Very, very high. So you know, roughly 4 times the volatility that we're used to seeing is what we were seeing back in the peak of the virus crisis, equivalent to what we were seeing back in the financial crisis. We've fallen off about halfway from that, but still about double the volatility that we're used to seeing on a regular basis. So things are calmer, but things are not back to normal calm, and that's why we're still seeing 2 and 3% swings in the stock market on a regular daily basis, which feels 2 and 3%. That feels very calm. 7%, but it's not normal. Normal volatility, usual percent or so. Here is the S&P 500, the most watched indicator, all large cap United States stocks. And you can see that we've rebounded. The market has rebounded from this low that was hit back on March the 23rd, I believe. And to give you an idea of how much the stock market has been a leading indicator, if we have seen in the market, I can't tell you that we're not going to, that I'm highlighting here. Goldman Sachs said we put in the low in the market on March 23rd. But if that's the case, at that time when we would have hit the low in the stock market, if that was the low, at that time only 5% of U.S. virus infections that would or will occur had taken place. Only 5%. That's how far in advance the stock market was in discounting the effects of the virus. Only 5% of the virus effects had actually materialized at that point. So I think that's an amazing, amazing thing. Again, can't tell you we're not going to revisit lows, but if that's the case, that's where the virus was. 5% into its damage, into its actual damage, with 100% of the stock market damage being done. So I want everybody to remember that. That's why advisors were always trying to tell people the market knows, the market looks ahead. It's already in the price. And in fact, that appears to have been the case, at least as it stands right now. This is the map of sectors composing the market and companies, and what really stands out. I need to change the color so that when I draw, I'll use blue. What really, so many things stand out. Look at Amazon. Look at that. Year to date. This is year to date. This is from January 1 to today. Amazon up 30% year to date. And Jeff Bezos, the world's richest man, is now for sure even more the world's richest man, as Amazon has benefited enormously from the virus. As people have been unable to go into retail stores, Amazon's enormous size and has come to be even more highly valued. And many people who had probably never used Amazon suddenly found themselves using Amazon. Microsoft, with its business tools being used. Netflix, 30%, similar to Amazon, as people say. I don't think I've watched much Netflix. We have a subscription. I just haven't had time. But look at that. Eli Lilly up 21%. Gilead, which is working on a a vaccine, up 20%. But by and large, it's mostly red. Lots and lots of red. Some big red. Look at this. Exxon and Chevron down 40% plus. JP Morgan, the banks, look at the banks getting hit really hard. American Express down 33%. Boeing, we know. I don't even know where Boeing's at. Doesn't tell us here, but down big. Emerson Electric down 30%. Where's Disney? Disney right here. Disney's had a tough go of it. Others have held up. Home Depot down -7. Facebook down 10. So not all tech stocks up. AT&T struggling. Okay, so that gives you a look. And just to point out again, look at the oil sector right here. Here it is. Right? Look what a relatively small part of the entire market the energy sector is. And so, yes, the news this week on oil is huge news, and it's had an impact, but not nearly the impact it would have had 100 years ago when Standard Oil or its heirs were still walking the earth like the giants. Much diminished are these giants. Okay. Clear the thing. Busy here. Annotate. Clear. All right. Here's the world of a similar story. This includes the United States, but other parts of the world. The U.S. accounts for about half of it. And you see that we've gotten the same bounce in world markets as we've gotten in the United States. And a similar picture as well. Similar picture as well on individual sectors. A couple things to note here. Shopify, on competitor that doesn't put its name on its sites, up 56% year to date. It helps small businesses establish their own e-commerce sites, and it's become, I think, Canada's 5th or 6th largest. But again, look at mostly red. Total. Let me do my drawing tool here. Total, the French oil company, Royal Dutch Shell down 40%. BP down 38%. Alibaba only down 3%. The Chinese internet company, Toyota Motor right here, not too bad, but lots and lots of red. Brazil really struggling. News came out of Brazil today that, look at that, down 60%, 40%, 58%. There's political turmoil in Brazil, which is exacerbating the market losses. It's about the worst I see anywhere in the world is Brazil. Now, what are people thinking about the stock market rally? Are they loving it? Well, no. Despite a massive rally, surveys are still showing not much enthusiasm for stocks, and that's often not a bad time to look at acquiring stocks. And most of you know, I've made trades and bought stocks during this period, but that's where the sentiment is. Still, people hunker down and not much interested in the stock market rally. That's what this sentiment indicator indicates. This is my calculation of S&P 500 valuation. You may remember I do that, and thing is that 10-year basis. Well, I got to change the color. Sorry, everybody. Maybe we're about 10% undervalued. 36. Market has rallied up from 2,200, something like that. This is assuming a 10-year Treasury discount rate with a 10-year Treasury of 0.6%, and ultimately a discount rate of about 6%. On a 20-year basis, stocks look really good on my model. About 36% undervalued. So if you have a really long time horizon, I do. I'm 4, so I've got a very long time horizon. 30 years, I don't know. That puts me at 84, but I could see it. Stocks look even better. About 50% undervalued. So the longer your time horizon, And 10 years I know is a long time, but you're only getting about a 10% discount, according to my estimates. Now, this is using the assumption, the consensus estimates for the S&P 500 earnings for 2020 and 2021 that Ed Yardeni tabulates. And the truth is, none of us know. We don't know. We just had earnings begin to come out for this quarter, and they're definitely being hit. Some are better than we were expecting. Some are worse than we were expecting. But of course, that's the big question. What are earnings going to look like? We don't really know. So I'm using Yardeni's estimates. There's really nothing better for me to use. He gets a whole collection of estimates from analysts who follow stocks, and I'm using his. But using his estimates, these are mine. So hopefully, this gives you some evaluations might be using those estimates. Of course, the big problem facing us is this enormous, besides the virus itself and the health effects that and the mortality effects of the virus, is the enormous amounts of unemployment that it has caused. We got news this week of another 4 to 5 million people with job losses, and this chart shows you what other periods of job loss look like. In 1975, in the stagflationary period, 2 million. 1980, this was Paul Volcker was the chairman of the Federal Reserve and tightened interest rates to get rid of inflation, to get a hold of inflation. That caused 2.5 million people to lose their job. 1991, that was under George H.W. Bush, 2 million. 1982, a double dip recession under Reagan, 2.7 million. 2001, the dot-com, but 2 million. 2 million seems to be about the amount that we tend to get in your average recession, right? Even 2009, look at that. With the financial crisis, 2.6 million. Look at this. I mean, you almost can't get your mind around this number. 22 million and climbing. I think we've now hit about 25 million. So this is a major challenge. And of course, what we're seeing now are wide-ranging and vociferous discussions, shall we say, about when and how to reopen the country. I think Georgia has proceeded today to open hair salons and nail studios. Everything that I understand am understanding is that Donald McNeil, who is really doing, I think, at the New York Times on the virus, he's phenomenal. He gave an interview to The Daily. If you don't listen to The Daily, you should listen to The Daily, the podcast of the New York Times hosted by Michael Barbaro. And he had Don McNeil on the other day. And Don McNeil, who has covered pandemics, including Ebola and SARS all across the world, and is a true voice of authority, says, we are likely in a period now where there will be openings, and we're going to see what happens. But we should all be prepared for lockdowns to return. At the hammer and the dance, the hammer of the government, the dance of dancing out away from the lockdown, and we see what happens. And that clearly is going to be the model that the United States adopts from state to state as we emerge and try to deal with this incredible problem of people being out of work. To remind everybody, the original bill in Congress in March, the CARES Act, gave about 2 months of unemployment. And that has really helped an enormous amount. To remind everybody, people are getting about $600 a week if they're unemployed. But that's going to run out at some point. And so that's why we're now getting a race now to on governors to reopen. So what happens after a recession? A recession and maybe even a depression. Well, here are some historical results. And by and large, what you can see is that things that are in blue, these are recessions going back to recessions and 1929, because in 1929, right here, this was a beginning of a depression. But you see that most of these, this is how many months into a recession, and do we have growth of a wealth on the y-axis? So starting with $10,000, X number of months into the recession. So 2 years into the recession, 24 months into the recession, what were the results? And you can see that most of these, you had positive returns. July 1953 and October, what is that? My things are 1926. Well, didn't know there was a recession back in 1926. November 48, 7, 81, 90, 45. All of these positive results. And we've only got out of all of these 4, 2007, 1937, and 2001, and 1920. What, maybe 14 or 15 or so, 15, let's call it. So what we might say is that, somewhere 70% of the time we have seen positive returns 2 years into a recession. Give you all an idea of what you might expect from stock returns, even during recessionary periods. Okay, few random thoughts. Payroll Protection Plan. This program has been renewed with another $350 billion. New Capital is not taking the Payroll Protection Plan. I looked at the application and they asked me to certify that. The question was something like, you are certifying that, you need this loan in order to avoid going out of business or something like that. I'm paraphrasing. I'm not getting it exactly. Well, I can't attest to that. We're doing fine, and we're proud of that. We're proud of the strength that we built as a company, and we're working very hard to serve clients. So I have decided that we're not going to do this payroll protection plan. We'd rather leave the money for all the big fat public companies. No, I'm joking. But it's turning out that is in fact the case. We'd rather leave the money for those businesses in the restaurant industry, in the retail industry, and so on. And hopefully this money, this renewal from Congress, is going to get more into the hands of small businesses. I hope that's the case, because it's really coming out in the press that there have been abuses. And I guess that's just the way things go when you're handing out trillions and trillions of dollars. There are going to be abuses. But it is sad to see that. I just talked about the hammer and the dance, and the fact that this is likely to be the model that the United States, through its various states, employs. A release of a lockdown, and then it may be a reimposition of a lockdown. It may happen in cities, in a state, but not necessarily statewide. It might happen in a state, but not in the nation. And so, and in the rest of the world, we're seeing all sorts of different models as well. China, by the way, is back to work. China is back to work. And so we continue to watch other parts of the world to see what their models are, their reopening models are revealing, and how they apply here. But for right now, it looks like the hammer and the dance is going to be the model here in the United States. I want to talk for a moment about the underperformance of value stocks. This has gone on for a few years now. I've talked about this, and it continues into the first quarter. We are at a historic disparity between the valuation on growth stocks and the valuation on value stocks. It is very, very high, and it's been exacerbated by the virus. I can't tell you how long it goes on, but growth companies that had been growing, like an Amazon or a Netflix, and their stocks had become so expensive, have gotten even more expensive. That is how out of ordinary the outperformance of growth stocks has been. I cannot tell you if and when we will see a reversion to a value. Our portfolios lean a little bit toward value. If you don't want that, I am more than happy to put you into a blended that takes off the value tilt. Just let me know. It's not difficult to do. I'm leaving my funds in the value area. Energy stocks now are a value. Banks are a value. A lot of the companies you see that have been really beaten up bad are value stocks. And over the long sweep of time, dating back to the 1920s, value stocks have outperformed growth stocks on average by about 2% a year. We don't know when that is going to happen. We don't and can't predict that it will continue. But that's just the way that undervaluation works. Eventually, it shows through. Anyway, let me know if you're tired of seeing value underperformance. I'll be more than happy to adjust your portfolio. I'm leaving mine as is, but you may decide to do something different. I want to talk about a few of our crisis partners. Dimensional has been stellar. JP Morgan, Vanguard, and BlackRock. These are four enormous and influential organizations. And I spend several hours a week on conference calls, webinars, emailing with these partners. And I just want to put in a good word for them because they have really been stellar in bringing their research and their skills to New Capital, and you as a client have benefited from that. One of my concerns this week has been in the area of municipal bonds. I'm going to talk about that in a second. And both JP Morgan and Vanguard have been very about getting feedback to me about what they are seeing in the area of municipal bonds. Why are we thinking about municipal bonds right now? Well, the majority leader in the Senate, Mitch McConnell, has said that it may be that the Congress is going to pass a law which will make it possible for states and municipalities to declare bankruptcy. And so that's going to naturally raise my concern about the state of municipal bonds. So let's talk about bonds for a second. Right now we see no inflation, maybe 0.5%. And so the question in bonds for many people are a large part of their portfolio, can be half the portfolio for many people or even more. And I showed you at the top of the webinar where treasury rates were, 1% and under, and inflation is very low. And oil dropping as much as it did, and oil is a major component in inflation calculations in the consumer price index. So the question is, do we bet going forward that there's not going to be any inflation? What about low interest rates? Do we bet going forward that interest rates are going to remain where they are in these incredibly low rates? Do we bet that local municipalities and states, localities are going to be able to weather this crisis? Try to hedge that assumption, especially since the majority leader in Congress is saying we may go ahead and let them go bankrupt. What about all the leveraged borrowers, especially in the oil business, who've taken on lots of debt, but not only in the oil business, others as well, where bonds have been issued in large amounts? Do we assume that they're going to come through? I can tell you that it's been a very strong period and a rebound for this last one, especially for lower quality. The Federal Reserve has been so incredibly active. The Federal Reserve is literally leaving it all out on the field and has made that very clear. We all owe a debt of gratitude to the Federal Reserve. And Jerome Powell has been pounding over the last years from Donald Trump. And the guy has been very, very absolutely resistant to responding to the attacks that have come from the president on interest rates, and especially on interest rates. And we really are indebted to Jerome Powell for keeping his cool and being in his job, because he and the other board of governors have done a fantastic job in bringing the Federal Reserve forward at this time to inject liquidity, which is what it should be doing. But do we arrange bond portfolios? Well, I'm not willing to make the assumption that we're not going to see inflation. And so as I finalize my inflation protected securities are going to be a part of that. We're going to be on the shorter duration side of things. If you see, as I showed you before, that you only get paid 1.17% or whatever it was on a 30-year bond, and you're getting paid 60 basis points on a 10-year bond, you're not getting paid that much more to loan for an extra 20 years. And so short duration is something that I'm working on in bond portfolios. I'm probably not going to be holding as much in the way of muni bonds. We're going to hold them, yes, but even in a taxable portfolio, I'm going to be reducing the amount of municipal bond because I'm not going to put the tax issue, municipal bonds are tax-free, but I'd rather people pay a little bit of taxes than a loss of their capital if in fact trouble. And I can't say that they're not going to run it. Not going to see a rise in inflation from all the money that's being printed, and I can't say that we're not going to see a rise in interest rates. And I'd rather get our gains in the stock market than in high yield bonds. To right now the current state of the bond market. I'm not willing to make these assumptions, either that we're not going to see inflation, that we're going to keep low interest rates, that localities, municipalities, states are going to weather this storm in flying colors, and that highly leveraged borrowers are also going to weather it. For me, your bond portfolio should be there for you, and it's there to make sure that your capital gets returned first. So I want everybody on the call to understand and to begin to think about bonds in a different way. Bonds are not there for a return. I think those days have passed us now that we've seen years market in bonds. Bonds are there to return your capital to you when you need it, but they're not going to provide returns. So if you want returns, you're going to have to hold stocks. Stocks are where returns are going to come from. Bonds are not going to provide much in the way of returns. My concern right now is to make sure that you get your money back from those to whom you lend the money, but they're not willing to pay. The borrowers are not willing to pay very much in the way of interest rates right now. So we all need to understand and adjust our thinking in our portfolios. Bonds are not going to be a place that provide much in the way of returns going forward. So that's it for the evening. We'll take question and answers at this time.
What is your take on the potential impact of states reopening their economies without adequate testing or tracing programs to prevent or mitigate runaway outbreaks? It seems to me that this will only exacerbate damage to the economy.
Well, this is the thing that could throw the stock market again. I think it's a really good question. And if there's one thing I'm concerned about with regard, it's that. It's that the virus gets out of control again. And I don't want to say, can't be stopped, but that the market is surprised by another outbreak. And so that is a concern. I think we should all be concerned about that. And hopefully even in a way that is sensible, makes sense, and doesn't get that result. Because I think that is the one thing right now that would cause the stock market to go haywire again, is that surprise. Any other questions?
Is this a good time for climate change funds?
Yes. Yeah. Yeah. I don't know about a climate change fund. It's a good time for us to address climate change as human beings. I would say that everybody's got a role to play. Every company's got a role to play. But it is a good time for us. Yes, all these questions relating to all these questions relating to fiscal stimulus. Excellent, and I think those actions should be pursued, whether it's climate change, addressing climate change and energy. I mean, we incredibly low. That makes it, on the one hand, harder to invest in alternative energy. The price of oil is so low, it doesn't cause a large incentive to reach for an alternative. But on the other hand, it means our incentive to invest in the oil business. Any other questions?
Yeah, one more just came in. Is there an infrastructure fund to invest in?
There are. Get with me, and I'll give you some infrastructure funds. I've looked at them before. You get stuff like toll roads and airport. Like airports in. When I've looked at them, it just hasn't been perfect. But fund looks like they tend to be more marketed than real infrastructure, but some have water projects and things like that. So whoever asked it, go ahead and I'll be happy to get you some information on what I have for that. Any other question? Oh, look at that. Who is that?
No other questions at the moment. Sorry, we've got a visitor.
We got a big. Nobody has asked me for the dewberry pie recipe. Nobody has asked me for the recipe. I'm surprised that didn't come up.
There's another question that came in, if you want to address it. It says, what unique economic impacts would result from high level, what unique economic impacts would result from high levels of state and metropolitan area bankruptcies, given McConnell's stunning remarks yesterday? Sorry for the noise.
Well, the cities in the states are already, many of them already in some fiscally with it is true there are pension plan problems in a number of larger cities. I don't know the answer to that. People are already resistant to paying more in property taxes. Services are already, in many cities, are pretty skimpy. Whether that's police or fire, road reconstruction, all of that it's not easy money. And I think that, frankly, the federal government is going to be bailing out just about everything left and right, and the Federal Reserve. That's not a bad thing. It's probably the thing that needs to be done. And the country has these very low interest rates, and people are willing to buy the bonds at those low interest rates. I don't think we're going to see bankruptcies. We've had some enormous distress. Going to see large-scale bankruptcies occur because I think the federal government ultimately will have to backstop municipalities and states. But I'm not going to take the chance by putting your entire bond portfolio into that sector. I can't take that risk. Even if there are some higher yields, I can't take that risk. I've got to find a way to diversify and protect your capital in the bond markets. Any more questions?
That is it for now.
Well, everybody, thank you very much. It's been great to be with you, and we'll let you know when we're going to do the next one. Maybe next week, but maybe not. We sort of play it by ear. I hope you have a fantastic weekend, and you continue to stay healthy, and we will look forward to being with you later. If you have any follow-ups, please make sure to get them to us, whether it's on an infrastructure fund or anything else, and we'll be happy to respond to that. Okay, Thanks everybody. Catherine, have a great weekend. Thanks for all your help as well.
Thank you.
And have a great weekend yourself. Bye.